From the 6th of April 2027, rental income faces new tax rates in the UK. 22% basic rate, 42% higher rate, 47% additional rate. That's a 2 percentage point hit across every bracket. Limited companies, though, stay at 19 to 25% corporation tax, completely untouched. The question isn't whether companies pay less tax. They do. The real question is, does paying corporation tax first and then dividend tax on extraction actually work out better for your specific situation? Or are you actually losing money if you want to live off the rental income? The answer depends entirely on how much debt you're carrying, what you do with the profits, and how long you plan to hold. That's what we're going to walk through today. Before we break this down any further, if you want to understand the hidden policy shifts reshaping your finances and property wealth, go ahead and gently tap that subscribe button now. Property Brief UK provides clear, timely insights and summaries that keep you one step ahead. Okay, one more thing before we go any further. I just want to reiterate that we are not offering any financial advice. We have simply done the research and are summarizing our findings. Please seek proper advice before following up on any of the strategies outlined in this video. And please, never actively try to avoid paying tax. Everything you do in this area needs to be legitimate and above board. Right, with that being said, let's get into the detail. As announced in the Labour government's November 2025 autumn budget, from April 2027, rental income gets its own separate tax bands. Your personal allowance goes against employment income first, not your rental profits. Everything you earn from rents gets taxed at 22%, 42% or 47% depending on tax bracket. The government estimates this affects approximately 2.86 million landlords and is part of broader tax changes, raising an estimated £2.2 billion by 2029 to 30. What this means is straightforward. If you own rental property personally and you're a higher rate taxpayer, your tax bill goes up. If you hold it in a company, you see no change. That gap is where the incorporation question comes from. But the gap doesn't automatically mean incorporation makes financial sense. You need to understand what actually happens when you incorporate and extract money. Here's where most people get this wrong. They compare 19% corporation tax to 42% personal income tax and assume the company wins. It doesn't if you're extracting all the money. Let's say you have £50,000 in rental profit as a higher rate taxpayer. Personally held, you pay 42% tax, that's £21,000, leaving you £29,000 to spend or reinvest. In a company, the company pays 19% corporation tax on that £50,000, £9,500. That leaves £40,500 available in the company. But if you want to use that money, you extract it as a dividend. And dividends get taxed at your personal rate. From April 2026, a higher rate taxpayer pays 35.75% dividend tax on dividends, though there's a £1,000 annual dividend allowance that's tax-free. So on £40,500, you use the allowance and pay 35.75% of £39,500, which is roughly £14,100. You're left with approximately £26,400. Compare the two. Personal landlord gets £29,000, company landlord gets £26,400. You're actually worse off if you're extracting everything. This is critical. Incorporating only works if you're changing how you use the money. If you're currently extracting all profit to live on, incorporation makes you poorer while you're still extracting at the same rate. The real advantage of incorporation isn't about the tax rates. It's about how mortgage interest gets treated. If you own property personally, you cannot deduct mortgage interest from your rental income. That rule came in 2020 under Section 24. Instead, you get only a 20% basic rate tax credit on interest, even if you're paying tax at 42%. This creates a gap. You're paying tax at 42% on profits that include mortgage costs, but only getting 20% relief back. That's a genuine disadvantage. Here's what that looks like. Say you have £8,000 mortgage interest and £30,000 rental profit. You're a higher rate taxpayer at 42% from April 2027. You pay tax on the full £30,000 as if that mortgage interest doesn't exist. That's £12,600 in tax. The mortgage interest credit gives back 20% of the £8,000, which is £1,600. Your net tax is £11,000. Now put the same property in a company. The company deducts 100% of the mortgage interest before calculating profit. It only pays corporation tax on profit after interest is removed. Same example, £30,000 profit, £8,000 interest. The company pays 19% corporation tax on £22,000, not £30,000. That's £4,180 in company tax versus £11,000 for a personal landlord, a saving of approximately £6,820 annually on this one property. Scale that across 4 properties on 75% loan-to-value, and the advantage multiplies substantially. A higher rate landlord with significant debt benefits genuinely from company ownership because of this interest deduction advantage. This is the compelling case for incorporation, not some theoretical compounding. It's this: the company can deduct interest fully, the personal landlord cannot. There's a second scenario where incorporation works, and it's different. If you're not extracting all your profits, but instead reinvesting them to buy more properties, incorporation gives you a head start. As a personal landlord, you make £50,000 profit, pay 42% tax, leaving £29,000 to buy your next property. In a company, putting aside the mortgage interest scenario for simplicity, you make £50,000 profit and pay 19% corporation tax, leaving £40,500 to buy your next property. You're buying with more capital because you paid less tax up front. But here's what this requires. You have to actually be reinvesting. You can't be extracting the money to live on. If you're planning property portfolio growth by buying more properties with retained profits over the next 10 years, this model works. You accumulate capital faster because you're not paying personal income tax or dividend tax as you go. You only pay tax once, at the 19% corporation tax rate, as profits are earned. When you eventually extract money, maybe at retirement when you may be in the basic rate tax bracket, you pay 10.75% dividend tax instead of 35.75% after using your £1,000 annual dividend allowance. Over a decade-long reinvestment period, this strategy genuinely works. But if you're a landlord who wants to extract money annually to live on, this scenario doesn't apply to you. Incorporating existing properties, in other words, transferring a rental property that's in your name into a company structure, costs real money. Stamp duty is applied on the full market value when you transfer property to a company. Since October 2024, a 5% surcharge is added to each SDLT band when transferring residential property to a company. A £500,000 property would therefore cost roughly £40,000 in SDLT. A £200,000 property costs around £11,500. Add legal fees, £2,000 to £3,000, mortgage exit or reapplication fees, £3,000 to £7,500, new mortgage arrangement, £3,000 to £4,500, and professional advice, £1,500 to £3,000. For a £500,000 property, total cost is roughly £50,000 to £58,000. For a £200,000 property, you're looking at about £21,000 to £29,500 total. This upfront bill has to be recovered by your ongoing advantage before you actually come out ahead. In the earlier example with £8,000 mortgage interest and £30,000 rental profit, the company structure delivered approximately £6,820 in annual tax savings compared to personal ownership. However, this figure is illustrative and depends entirely on your actual mortgage interest amount being offset against profits in the company structure. If you have 4 properties with similar mortgage levels and gearing, you could see annual savings of approximately £27,000. In that scenario, total SDLT costs of roughly £200,000 would break even in around 7 to 8 years, accounting for transfer costs and ongoing administration. Your actual break-even will vary based on your specific mortgage debt levels and property values. So when does incorporation make sense? It's not complicated once you separate the scenarios. Incorporate if you have 4 or more rental properties. Your properties carry 70% plus loan-to-value with substantial mortgage debt. You're a higher rate taxpayer, so the mortgage interest relief advantage is real. You're planning to hold for 10 plus years. You're either reinvesting profits to grow portfolio or deliberately delaying extraction until retirement. In this scenario, the mortgage interest relief advantage compounds across the portfolio, and the break-even point, typically 7 to 10 years, depends on your specific SDLT costs and how much mortgage debt you carry. Stay personal if you have 1 to 3 properties only. Your properties carry low to moderate debt. You're a basic rate taxpayer. The interest relief advantage barely exists. You're planning to sell within 5 years. You extract all or most profits annually to live on them. In this scenario, the SDLT cost is high relative to your annual savings. You're also making yourself worse off on extraction because you pay corporation tax plus dividend tax rather than just personal income tax. There's a middle ground. If you have 4 properties, moderate gearing, you're a higher rate taxpayer, but you're unsure about your timeline, you need to run the numbers with a tax accountant. Calculate your actual annual mortgage interest relief advantage, divide your SDLT cost by that, and see if the break-even timeline matches your plans. Before concluding, I wanted to give one important warning. HMRC specifically targets Phoenix company activity, which means winding up a company to extract profits at low rates and then continuing the same business through a new entity within 2 years. If caught, they reclassify what you did as income distribution taxed at 39.35% rather than capital gains at 24%. Penalties are severe, up to 100% of unpaid tax if discovered without disclosure. The rule is simple: incorporate properly for legitimate reasons and stick with the structure, or don't do it. Don't try to outsmart HMRC. From April 2027, the tax cliff is real. Individual landlords pay more, company landlords don't. But that doesn't mean people should jump into company structures without due thought. The compelling case for incorporation is mortgage interest relief. If you have high gearing properties and can fully deduct interest at 100% instead of taking a 20% credit, that advantage is real and substantial. It justifies the SDLT cost if you're holding the properties long term. If you're extracting all profits to live on annually, incorporation actually costs you money compared to personal ownership. If you're reinvesting profits to grow the property portfolio and planning to hold for 10 years, incorporation works because you avoid personal income tax and dividend tax as you grow. The worst reason to incorporate is chasing a theoretical tax saving on rates you'll never actually pay if you extract the money. Don't do that. Get professional advice from someone regulated by one of the main accounting boards. They'll calculate your specific mortgage interest relief advantage and run break-even numbers on your actual portfolio. That calculation is what tells you whether to incorporate or stay personal. You've got until April 2027. That's 18 months. If you're holding 4+ properties with meaningful debt and planning long-term, it's worth exploring now. Otherwise, stay as you are. If you found this breakdown helpful, don't forget to hit that like button and subscribe to Property Brief UK for more essential updates on the UK property market. We cover everything from legislation changes and market trends to practical advice for tenants, landlords, and investors. Ring the notification bell so you never miss an update that could affect your property decisions. Thanks for watching, and we'll see you in the next one.